Thank you for joining us. Today, we're very excited to have Bench Ansfield sharing their work with us. Bench is an assistant professor of history at Temple University. And Bench recently published their book, Born in Flames, The Business of Arson and the Remaking of the American City. And I bet you've seen some write-up about it in the New York Times or elsewhere. It's gotten a lot of great press. And Bench will be sharing their paper with us today. You'll see the title on a slide in front of you now. And we're really excited to have you. So thanks for coming, Bench, and take it away.
Uh, Thank you both, Travis and Peter, for the invitation. Thank you to Nikki for coordinating all the details. It's really wonderful to be here with you all. I can't tell you how refreshing it is to be amongst other insurance heads. I usually find myself in crowds where I have to spend half the talk making a pitch for why insurance is deserving of the crowd's attention. So yeah, it's nice to find myself finally like preaching to the choir, I guess. So the focus of my remarks is going to be on the origins of the FAIR plans, and specifically the New York FAIR Plan, the state's property insurer of last resort. I'll be drawing from my recently published book, Born in Flames, elaborating on the article in the Journal of American History that was pre-circulated. So the FAIR plans, as probably many know, were first introduced in 1968, and they were introduced by a kind of a little known offshoot of the much better recognized Kerner Commission. And that offshoot was called the Hughes Panel. The Hughes Panel, like the Kerner Commission, had been convened by President Lyndon Johnson in response to the mass uprisings that shook American cities in the summer of 1967. Lyndon Johnson had tasked the Hughes Panel with stabilizing the property insurance industry, which was really in the midst of abandoning the U.S. urban market in some pretty dramatic ways. And this was after it absorbed some, relatively modest losses from the decade's uprisings, modest at least compared to other loss events like hurricanes. And that nationwide flight of insurers from American cities was so rapid and so extensive that you even saw instances of government agencies getting their coverage dropped. So in August 1967, the Philadelphia Housing Authority, the largest landlord in Pennsylvania, found itself suddenly uninsured. And this was, in a climate of what the press called riot jitters. The PHA's insurer, the Mutual Fire, Marine, and Inland Insurance Company, had informed the housing authority that its 3-year insurance contract, which it had signed just a month prior, was suddenly null and void. And some, readers of the Wall Street Journal or Inquirer, where this was reported, might have been surprised that, a large government agency could be at the mercy of the private property insurance market. But this was, very much how the economic infrastructure of American cities had been built, right? The authorities, 40 some housing projects, 1,000 rehabbed homes, all of which were valued at $118 million in 1967 dollars. They all relied on private insurance for protection from common hazards like fire. And now with this cancellation, the future of these properties, home to tens of thousands of Philadelphians, was suddenly cast in doubt. And a very similar process actually played out with the Philadelphia school district. 5 months after this cancellation, in January 1968, the Hughes panel completed its report, meeting the insurance crisis of our cities, which is honestly a fascinating read and readily accessible, Googleable, if anyone's interested. And within just half a year, by August 1968, its recommendations had been quietly codified into law. And this is very different from the trajectory of the Kerner Commission and the Kerner Report, most of which never never were acted upon. And during the Hughes panel's investigation, the appointed lawmakers and industry executives who were on the Hughes panel had singled out property insurance redlining in so-called riot-prone areas as both a cause and a consequence of the uprisings. And their proposed corrective was the creation of these new statewide companies called fair plans, which stood for fair access to insurance requirements, which they billed as a progressive remedy for insurance redlining. These new public-private insurance companies would be sponsored by the federal government and overseen by individual states. And in exchange for companies' mandatory participation in these high-risk insurance pools, the private insurance firms that made up the market in a given state would be offered federally sponsored riot reinsurance on losses resulting from future uprisings. And the FAIR plans were very much introduced and framed as a racial justice measure, though in reality, they often sold pretty substandard policies with poor coverage, and they were often very pricey, like pretty exorbitant premiums. So instead of redistributing access to insurance in ways that would have been maybe more meaningful for the urban residents that the program sought to help, the program ended up setting the stage for further ruin. In New York, which boasted the country's largest fair plan throughout the 1970s, the coming of the plan meant it was actually very dramatic. It meant the total overhaul of the urban property insurance market within a year and a half of launching the state's fair plan, which is called the New York Property Insurance Underwriting Association, or NYPIUA. It had become the largest underwriter of fire insurance in the state. And its growth in New York was particularly exceptional, but it was in step with fair plan expansion across the country. By 1970, there were fair plans in 26 states, a tally that went up to 31 by 2021. Increased access to insurance, importantly, didn't spell the end of redlining. And this is like a twist that didn't really become evident until the end of the 1970s, that the advent of the NYPIUA brought both expanded access to insurance coverage and the expansion of the high risk residual market. So in other words, the coming of the FAIR plan actually hastened the flight of private insurers who had already been abandoning the city, but now the FAIR plan took their place and essentially filled in the gaps. And the proliferation of its policies did mean the return of fire insurance, which had to neighborhoods which had previously been written off as uninsurable. But far from dismantling the kind of structures of the pre-existing residual market, the NYPIOA was very much built atop its foundations and ended up fortifying them along the way. So delineating where the FAIR plan falls within the history of insurance redlining um, is kind of like traversing a discursive minefield. Since the 1970s, some scholars of mortgage redlining and mortgage lenders themselves have adopted the term greenlining to describe post-1960s efforts to draw investment or insurance coverage back into redlined neighborhoods. But with its kind of triumphalist, self-congratulatory undertones, greenlining was ill-suited to the FAIR plan, obfuscating how it not only maintained the residual market, but actually amplified it. Nor can I, keep using the term redlining to capture the complexities of the post-68 period, right? Because things really had changed. So in order to differentiate the post 68 residual market from both the insurance redlining that preceded it, as well as from the false promises of greenlining, I use the term insurance brownlining to describe the impact of the NYPIUA. And just as red and green blend to create brownlining captures the sedimented relationship between redlining's residual presence and the FAIR plan's abrupt infusion of insurance access. Brownlining meant a dramatic increase in access to insurance, but it was access that was on these discriminatory terms of these substandard insurance contracts. So this actually led some activists at the time to call it back of the bus insurance. Despite these shortcomings, the Fair Plan did allow property owners to hedge against the many precarities of the 1970s. This is a decade known for its fiscal crises in particular. But in neighborhoods like the Bronx, where rates of homeownership were particularly low, this protection pointedly did not extend to the renting masses, right? And that was no mistake. So the Hughes panel, again, the architects of the Fair Plan, had refrained from considering tenants as they went about doing the research in their preparations for proposing the program, despite conducting some 3,000 interviews, most of them in renter-dense cities, Boston, Cleveland, Detroit, Newark, Oakland, and St. Louis. The researchers were unapologetic about speaking only to owners of dwellings, but not tenants. And so the New York Fair Plan, like those in other states, offered no renters insurance, and Bronx tenants gained little when their landlords secured coverage, right? There were no stipulations that the property needed to be kept up in a certain way. So as Bronxites watched their neighborhoods undergo cuts to fire protection, healthcare, sanitation, and other services, the arrival of the New York Fair Plan really did nothing to counteract these austerity measures or even like attenuate them, right? And through a cruel irony of history, the Bronx, which actually had largely been untouched by the uprisings of the 1960s, was perhaps more sharply impacted by its actuarial designation as a riot-prone area than any other section of the country. It does bear asking, like, what was a riot-prone area? Since this was actually the language that was used by the architects of the program, policymakers didn't bother to define it. And that's, kind of how easily this, it's very clearly a euphemism for Black and brown neighborhoods, but this is kind of how easily this clinical jargon of risk could communicate race, right? So the book is actually really interested in this, like how after the civil rights victories of the 1960s, the undisguised racism of Jim Crow found these sort of colorblind avenues of expression. And the discourse of risk proved to be one realm where racial discrimination could very much survive in a socially acceptable form. Of course, there's some degree this is not new. Risk had long served to encode race. You can point to early life insurers' reliance on underwriting decisions to the invention of a statistical link between Blackness and criminality by a prudential actuary in the late 19th century, right? Frederick Hoffman. But risk's importance to maybe you could call it racial grammar grew significantly after 1968. So if you consider kind of which populations are usually implied by terms like at risk or high risk or risky, right? These are phrases that are now ubiquitous in education, in the education sector, in the criminal legal sector. All of these terms map difference. They all map difference with terms that are essentially lifted out of an underwriter's manual. And so it was that one of the federal government's few legislative responses, direct legislative responses to the 1960s uprisings, besides the militarization of policing, which was also happening at the same time, involved a property insurance program that claimed to end insurance redlining, specifically in these riot-prone areas. Now, the New York Fair Plan's policies flooded into the Bronx market at precisely the point at which the borough, like many cities across the country, was showing creeping signs of total deterioration. And those are the words of one neighborhood activist, Hetty Fox, in the Bronx. And with the Bronx visibly in decline, private insurance companies were even more eager, right, to hasten their exit. The NYPIUA scooped up this kind of actuarial jetsam as it was dumped. By 1971, it was the only property insurance available in 90% of the Bronx. But who could afford these policies, right? These policies which regularly ran 4 to 5 times the standard rates, especially given the increasingly delicate margins of profitability in Bronx real estate in the 1970s. As one broker noted, only half in jest. The only people who can afford the fair plan are those who are planning to have fire. And as the cost of insuring with the NYPIUA continued to shoot up over the course of the 70s, those most likely to avail themselves of its insurance were absentee landlords, right, who were far removed from the well-being of those buildings and of their tenants. According to theories of insurance, underwriting decisions about which risks can or cannot be covered and at what price that coverage can be sold, these should incentivize owners, right, to safeguard their property. So, in the words of one insurance executive, historically, the withholding of property casualty insurance has been a disciplinary device. The advent of the FAIR Plan had put these principles to the test, he went on, for they continue to provide insurance coverage in the face of conditions that argue against such protection. Indeed, the FAIR Plans disrupted this system of incentives upon which the insurance principle was constructed. And one sign that the FAIR Plans were failing to serve as this disciplinary device was in their very oblique relationship to housing rehabilitation. So when an inspector observed safety violations in an applicant's property, that inspector and the NYPIUA didn't relay those infractions to the policyholder. It simply increased the premium. In other words, it no longer really participated in this relationship of trying to incentivize landlords to keep up the given property. And this disconnect evidenced a growing gap, right, between the financial protection afforded by property insurance, and specifically by the FAIR Plan, and the physical condition of the insured property itself. And of course, this is far from unprecedented in the history of insurance. Ian Balcom, a theorist of the Atlantic slave trade, argues that the insurance contract does not insure things, it insures a form of value. And even the most comprehensive property insurance didn't promise to secure the safety of a given building. It could only indemnify the building against the possibility of financial loss, right? This is the basics of insurance. Insurance doesn't, it doesn't eliminate risk, it mitigates risk, right? So for Bronx tenants, the insurance industry's increasing apathy about what their landlords ultimately did with their buildings or with the insurance settlements. This was salt in the wound of their increasing housing precarity. It seems that the landlords really like who most benefited from this really had a very weak allegiance to the upkeep of the buildings, right? There was no again, no stipulation requiring insurance proceeds to be put toward repairs. And this evidenced a deep and deepening chasm between the FAIR Plan and the communities it was created to serve. Bemoaning that disconnect, one insurance vice president remarked that the intention was that by providing insurance through the FAIR Plans, a substantial contribution would be made to the revitalization of the inner cities. It appears at times that the real beneficiary has become the slum landlord who, after making an insurance claim for the amount of repairs, walks away from the property, leaving a burned out building. And this was no hyperbole, right? So soon after the establishment of the FAIR Plans, a wave of arson for profit began coursing through cities nationwide. And it wasn't just the Bronx. This is from, this happened from Hartford to Phoenix. You can actually see the scope of the phenomenon in this map, where the 40 states in red all saw the formation of anti-arson organizations over the course of the 1970s. In the book, while attending to this national and even the transnational sweep of the history, it does very much zero in on the Bronx. known in these years as the arson capital of the world. The Bronx lost approximately 20% of its total housing stock to fire or landlord abandonment between 1970 and 1981. This was in the ballpark of 100,000 units of housing, the equivalent of New Haven, Connecticut burning down twice over. Um, a recent study put out by economists at the Federal Reserve Bank of Chicago and Philly, which is soon to be published, I believe, in the Review of Economics and Statistics, confirms this finding, concluding that the availability of fair plan insurance when controlling for other variables was associated with significant increases in housing abandonment and arson throughout the 1970s. And though the rate of destruction in the Bronx was exceptionally high, it was of an order of magnitude actually relatively consistent with other cities. So I'll start wrapping up. Like what's there to grasp from this very capsule history of the New York Fair Plan that I've offered you today, and specifically what's there to grasp about governance and political economy in the 1970s? The book argues that the growth of the Fair Plan offers a dramatic contrast to the downsizing of many other state institutions during the decade. So nowhere were these shocks felt more acutely than in New York City, whose fiscal crisis and the responses that it generated are credited with really ringing in a new era of urban governance. New York historians have shown how by the mid 1970s, New York City really became a laboratory for austerity politics and the hollowing out of the welfare state. On the other hand, historians of the carceral state have pointed to the 1970s as the kind of the other side of that welfare retrenchment, right? With the rise of mass incarceration over the same period, as the state turned increasingly to the punitive policies in managing the growing precarities of what was being called the urban crisis, right? Deindustrialization and the loss of the tax base and capital flight, etc. So where did the FAIR Plan fit between these two processes? I ultimately argue that rather than advancing a punitive or a progressive political agenda, what it did was it picked up the slack of a social safety net that was riddled with holes and going limp. The program was a stopgap as the U.S. entered a prolonged period of economic recession and welfare retrenchment. It indemnified real estate and property insurers against the social and economic shocks of the urban crisis. No, the FAIR Plan responded to a similar set of pressures as the carceral state. It aimed to generate security not through punitive policies, but by protecting the financial interest in property. I ultimately call it a regressive form of welfare state expansion, broadening the entitlements of citizenship for a chosen few property owners. And because of the dynamics of property ownership in Black and Brown neighborhoods, the very neighborhoods it was intended to serve, the primary recipient of its coverage was most often the predominantly white landlord class. So at the same time, it's important to note that the program served insurers in a number of ways, one of which was securing the elasticity of the residual market. And in this way, the reinsuring of the Bronx and other cities was an instance not of like a redistributive welfare state, but of a financialized state. But of course, access to property insurance was no substitute for a social welfare system, especially for Bronx renters. But regardless, Fair Plan's policies, suddenly appeared on the scene at the same moment that all of these other processes were playing out. And though it wasn't meant to serve as a replacement for this broader system of social welfare, brownlining represented one of the few direct legislative responses to the 60s uprisings, one of the few expansions of the state in this moment. And absent a farther reaching legislative program, insurance access in neighborhoods like the Bronx, it ultimately proved to be a weak protector of property and an even weaker guardian of neighborhood well-being. So I'll stop there, and I'm looking forward to um, our conversation and hearing your questions. Thanks.
Thank you. That's great. Um, there's a ton there. So I'll open up the queue. If you would like to ask a question, you can use a little hand raise function or send me a message in the chat. Um, and so I'll wait for a second to see who'd like to ask the first question. If not, I will, but I don't want to. Peter, go for it.
Sorry. Yeah. So thank you very much. You didn't use, I didn't read the book. I read the article and I listened to your talk, and you didn't use the word tragedy anywhere. But doesn't this just seems like it cries out for like what else can you call this? Because it was a sort of toxic combination of good and bad intentions, like merged together with lack of understanding and sort of people who were trying to do the right thing and people who were trying to scam other people and people who were just uncertain about what they were doing. So I guess is it your sense that like this this tragic equilibrium was kind of designed by anybody, or is it more like a bunch of independent actors with all kinds of motives came together and hit on something that just turned out to be spectacularly awful? Like what? So yeah, any reflections on that kind of large scale question would be welcome.
Yeah, it's a great question, and it really gets at the question of conspiracy, right? Which is, interestingly, the way that this book has been classified by some reviewers is true crime, which is a very surprising development for me. Um, but it's I think it's easy for folks to see this as this kind of um, yeah, this kind of premeditated thing. And the book is filled with these large scale arson rings that were actually, I mean, that were conspiracies, right? They were, could be 20, 25 people deep, involving not just landlords, but insurance adjusters, cops, fire marshals, lawyers, and then of course the folks that landlords hired to do the burning for them because they often didn't want to actually do that. It was a way to insulate themselves from prosecution. So there's actually no shortage of conspirators here, but the book like explicitly cautions against seeing this as a conspiracy, which is kind of what the genre conventions of true crime would ask us to do. Um, you know, human hands lit those fires, but they were set in motion by forces that were far-reaching and far more impersonal, right, than a criminal cabal, right? This was, and the book argues that this is very much a story of financialization, a tragedy of financialization, right? And one of my like darlings that I had to kill in the revisions process was I called it not a who done it, but a what done it. But my editor didn't like that line. But that's really how I feel, and um, it was a perfect storm of factors, and very much a tragedy, but definitely a story of unintended consequences. So
Great,
thanks for
Andrew.
that.
Thank you. Big fan of the work. I wanted to ask about so like the recent wave of interest in property and casualty insurance is about essentially like the looming disaster of Florida and California in particular. And until very recently, the National Flood Insurance Program often wildly underpriced premiums for homeowners in floodplains and on the Gulf Coast. It seems like increasingly the state is being asked to take on a more and more direct role in trying to subsidize these like homeownership related premiums because the actuarially fair rate is just implausible for people to be able to afford. And so I'm wondering about to what degree you think this sort of experience is generalizable, and whether we should take as a lesson from this essentially that the state should never try to interfere with actuarial fairness because we really don't know what kind of forces that unleashes, or whether it's not maybe, or if that's overreaching.
Yeah, it's a great question, and let me just, I guess, start by saying that that flood insurance program, I mean, which I was very surprised. I knew about the flood insurance program prior to beginning this research because I had written an undergraduate thesis about Katrina, and that the National Flood Insurance Program, was actually kind of politically toxic until this moment, until 1968. It only actually was passed because it was carried on the back of the FAIR Plan, essentially, or this riot reinsurance legislation. Uh, Policymakers had been trying to get flood insurance, the program passed, through Congress for years, I think since the 50s, but used and I get at this just like a little bit in the book, that they used the crisis of the uprisings essentially to tack it on to riot reinsurance legislation. So that was just fascinating to realize. But then these were two like fundamentally different programs that had very different effects, right? So the FAIR Plan, introduced what was, what you could crudely think of as subprime insurance into neighborhoods of color, benefiting landlords, and then producing these perverse incentives. The flood insurance programs produce a different set of perverse incentives, but ended up heavily subsidizing, coastal home construction, and in a lot of ways setting the stage for our current climate crisis, right? So it's a the kind of abundance of historical ironies, um, is something really to kind of, yeah, it's a lot to take in. The I don't actually think that the problem is that the state should never get involved, and I make the argument that the problem was not state interference or like the distortion of free markets, but rather the way that this kind of knee-jerk protection of property above all else, right? So in other words, the problem wasn't too much insurance. It was the more general step away from social insurance, right? And that's not the FAIR Plan's fault that like the state abandoned general, at almost in every other way was abandoning these neighborhoods, but it was just left to the insurance function to like address these deeper social problems in a way that's actually very similar to what the FAIR Plan is being asked to do today. But again, like we're not going to solve climate change with an insurance program, right? Like it just so happens that is the kind of stopgap that's there. So they will continue growing areas that are on the front lines of climate change. And it's been, I actually, I discovered pretty like embarrassingly late in the research process, not until I was writing the epilogue, um, that the FAIR Plan had, which was created essentially to resolve the contradictions of the 1960s and the urban crisis, had become by at the latest, the 20 teens, had become the principal insurer of the nation's huge and growing amount of flood and fire prone property. And it was really kind of dizzying for me to this is like a typical historian thing to do. Like I started my dissertation and just like like hunkered down in the archives and like didn't look up for a bunch of years basically. And by the time I did, like all of a sudden there were newspaper headlines about the FAIR Plan, and there were people who wanted to talk to me about it. And I am still kind of in disbelief, because at the beginning it was very again hard to get anybody interested. Um, but I think there's real lessons to learn here about our current conjuncture and our current crises and what insurance can be expected to do in the face of that. I mean, ultimately, in the absence of farther reaching reform, insurance is just a band-aid under which the wounds, the original problems will continue to fester. That's very much what happens from the 60s going into the 70s. And I think that there's, that should really give us pause in our current moment as insurance programs are asked to assume a similar function today.
Grace, I'm going to throw myself on a queue with, I think, a kind of silly, dumb question, but maybe on other people's minds. So when I teach property insurance, one of the and particularly homeowners insurance, one of the things that we focus on is the exclusion for intentional acts and policies like this, and specifically the exclusion for arson, because it's a feature of my sense anyway is that it's a feature of a lot of homes that like it would benefit the homeowner for one reason or another to burn it down and take the insurance money rather than just liquidate the house. And so um, and my sense is that that kind of works in terms of aligning incentives between the homeowner and the insurance company under normal circumstances. And so I also presume that there was a similar exclusion in these fair policies. And so like why didn't that work here? Like what I imagine there's a story to be about that.
Yeah, I mean that's a lot of the book is like this big kind of mystery that takes a long time to solve because there's so many questions about why insurers would go along with this that like are not easy to address. There's the kind of the easiest level of analysis is just that um, for a fire to be called arson, you need a fire marshal there to determine that it was arson to carry out a real investigation. It takes a lot of time, takes a lot of manpower that New York City was not in a position to pay for in the midst of its fiscal crisis. At points in the 1970s, the Bronx, which if the Bronx were its own city, it would have been the sixth largest city in the country at the time, had maybe two or three fire marshals like on staff. And we're talking like 30 fires a night. So, if a fire is not classified even as suspicious, then it's just not going to trigger any of those insurance companies to refuse the claim. Even when a fire was actually marked as suspicious or arson, it was often the case, especially with the FAIR Plan, that it was just easier to pay than go through all the litigation that they feared would be forthcoming. Um, and this is part of the kind of specific dysfunctions of the FAIR Plan and kind of especially what it was in the 70s, less so today. But the fact that, this is this brand new thing, it's a pool of every insurer in a given state, any losses that it produced, and it did produce losses, right, for much of every year but one, the New York Fair Plan in the 70s produced losses. So it wasn't like a predatory, it wasn't as though insurers were making out from this somehow, again, to the kind of conspiracy aspect. Um, it was more that Aetna was okay taking whatever sliver of a loss that it would have to assume because of its proportion of the statewide market, because it knew that the Travelers was going to have to take a loss commensurate with that. In at the end of the day, it was actually for the individual companies, hundreds of companies that made up the pool, relatively small. The other side of it was, of course, and this is where it links to this kind of bigger meta narrative of financialization, which is kind of one of the bigger kind of war horses that the book is um, trying to address, is that the structure of profitability in insurance companies was changing pretty dramatically in the 1970s. So now I'm not talking about the fair plan. I'm talking about the individual private insurers that make up the pool. Um, they were making so much money on their investments for the first time, that they were rethinking kind of what the underwriting function represented in their own kind of strategies and profit plans. So they, I mean, and this is in terms of like deep history, this was actually like a pretty novel development. The loss ratio had for 300 years been the kind of, cornerstone of the industry. And then suddenly in the 1970s, they're making so much money on their investments and in these new money markets and stocks and bonds and real estate investments, that whatever losses the fair plans produced were losses that they were simply willing to accept, right? They actually started thinking of premium income as as seed money, for those investments, rather than just as a way to kind of offset inflation, or however they had thought of investments prior. Investments were new, but this new, investments being the profit driver of the company, that was new. So underwriting losses, they started to just kind of tolerate until they didn't. So I'm going to actually share my screen again because there's some really amazing advertisements that the industry ends up putting out when it kind of declares war on arson. Can you see this?
Mm-hmm.
Yeah. Okay. So this is an advertisement that runs in a whole host of national um, magazines and newspapers, and they essentially, like, for the first maybe 8-9 years after the creation of the fair plans in 1968, arson really doesn't figure in to the like industry imaginary much at all, even though like that's the kind of peak of the arson wave. um, it wasn't until 1977, when it becomes like a major story in the media because of a host of factors that I could get into, that insurers realize they have to kind of like take control of the narrative, and they announce themselves as anti-arson zealots, and they put out advertisements that are just mind-boggling. I mean, this one from the Travelers is basically my entire book in 2 lines of like Madison Avenue advertisement copy. The profit motive built this building, it also burned it down. Like, they said it, and it was fascinating. I couldn't get permission to reprint this in the book. I was able to do the Aetna ad. But I ended up having conversations all the way up to the general counsel of some of these major insurance corporations, talking about just image permissions for the book, and they're seeing these images for the first time, and they can't figure out how to even process them because they can't imagine why they would do this. Like, literally, the question I got at one point from one of these meetings was, "Were we the good guys or the bad guys in this?" Because they are, which is just amazing. Another one that I don't actually have a digital copy of, so I'll stop sharing my screen, is of an insurance executive literally eating crow, like eating, like in a tuxedo. Can you see this? I know it's not ideal. Eating a plate of crow. So that's just kind of like how um, surreal it became. Um, but eventually they did actually, part of it was obviously optics, but they did actually commit to anti-arson reforms, and actually did play a major role in cracking down on the practice. And then it actually, once they did, it dwindled pretty quickly. But that your question is a good one. I mean, that is the mystery of the book.
Great. Queue is open for questions. Carly.
Thank you. Carly Fabian from Public Citizen. I had a question about something you mentioned earlier about redlining as both not just a consequence, but a cause of the riots. And I think typically people will think about redlining related to banks and mortgage providers, but less about insurance. I'm wondering if you can say more about that. And then as a follow-up one that's a little more speculative, was there a road not taken here? An option
Mm.
to maybe require insurers to offer coverage in certain areas, to crack down on discrimination, investigate more heavily? What might that have looked like?
Thanks, Carly, for those great questions. Yeah, I mean, I had to teach myself that, the redlining that I had learned about, since high school, everyone was just talking about mortgage redlining, that insurance redlining was its own beast with a different history, actually, like a pretty significantly different history. Like it starts some 15 years after, the famous Hulk maps are first drawn up during the beginnings of the New Deal. Um, and it starts because of a different set of factors that have more to do with kind of the intricate idiosyncrasies of the industry. And so you know, um, there are I have to excavate all this history all by myself. Actually, the Hughes panel did a lot of it for me. But I did have to really kind of like reteach how I thought of redlining, and it's often confusing for my audiences to kind of separate the two, and especially for people who are not homeowners, like just understanding that if you don't get property insurance, it's effectively the same as mortgage redlining. Like you just can't access a mortgage, right, without property insurance. And yet, like the kind of asymmetry, the lopsidedness of the scholarship in terms of all of this attention to mortgage redlining and very little to insurance is a detriment to the scholarship and to advocates and activists like you who are trying to piece together what these underwriting practices mean and how to intervene in them. Um, in terms of kind of missed, I was going to say missed connections, paths not taken. um, there are so many, and the sometimes I get asked about like you know how does this map on to health insurance debates, and um, it's obviously it's very hard. Like they're different worlds in a lot of ways. But had the federal government, embraced something closer to single payer health insurance instead of the FAIR plans, it would have, eliminated the racially tiered market of property insurance altogether. And if it were designed in certain ways that actually, I mean, it would have been pretty simple to bake into the program a disincentive to arson, which was a possibility that some of the members of the Hughes panel raised and were worried about. Simply by saying, we need rigorous inspections, like that just didn't that was not a concern. Um, and so there, it was very common for inspectors to do drive-by inspections, to never actually leave the car in deciding, whether a building was insurable or what rate it would be insured at. Um, and those kinds of like very simple, very common sense anti-arson practices could have easily been incorporated into the language of the legislation. They simply weren't. Um, Again, because this was a program to that was centrally interested in property owners more than anything, insurers too, but like protecting the real estate markets was one of its major goals, and the idea that tenants could end up losing out, like just the idea that like most of these neighborhoods, of riot prone neighborhoods, were renter dominant neighborhoods. was not one of the major considerations, which is one of those mind-boggling kind of paths not taken, myopias that I kept running up against. Thanks for that.
Great. Mark.
Hi, Bench. Thanks so much for your work here. The book, I agree, is fantastic, and I've followed the whole process of birthing from when you were in graduate school, first publishing, and thank you very much for your personal perseverance in bringing such important scholarship to light, and also for the just congratulations for the amazing reviews. One thing that our group hasn't mentioned is how well written the book is and how much attention you've spent to writing, good lines in it. And I'm going to share one in a second because it also captures part of the picture of what you're powerfully portray. So one of the insights that you make clear is that the value of a building is not in its cash flow, but in its exit payment for the owner. And that exit payment can be through gentrification and being bought out, or as you say, just because I want to show off and emphasize the power of your book. At page 208, you write, Arson enabled a just-in-time eviction with an insurance payout to boot. So you very much explain that, just this structure creates it. Just the game plays out where you have the incentive not really to invest in maintenance. You're not really trying to raise the rents, because raising the rent is a fool's errand, because that's not the game that they're actually playing. The game they're playing is playing for the exit. And the exit is either, the next guy who's then going to do it in gentrification, or they burn it down. So
Yeah.
it just was very, powerful how, the invisible hand works in disciplining ways and creating these incentives and the like. And then the discussion you just were highlighting is just, the problem of agency cost or agency, distributed agency, and then ultimately nobody's paying attention because nobody has enough incentive to take on more than just their little piece, and it just gets passed on. So I don't have much of a question other than just to convey to you my praise of the book, the recommendation to everyone, and to have you keep doing this kind of stuff.
Wow, Mark, thank you so much. That means a lot. I was really trying to figure out a way to make insurance like something fun, like something that would keep readers engaged, which actually wasn't that hard in the end. But I that was kind of one of the things, one of the considerations at the top of my mind as I went about adapting the dissertation into the book. And I actually think that insurance, yeah, is like the most fascinating thing. Again, don't have to convince any of you, but like, it does, because it pretends to be so boring or like, confusing and complex for like lay people to understand. Most haven't thought about it except in like the most stressful moments of their life, right? Like when they're, coming off of a fire, or like trying to figure out how to get coverage for a life-saving care or whatever, and then they don't want to ever think about it again. And so like I knew I had to contend with like like when I give talks, not to insurance experts, I like sometimes like I literally watch the first time I say like the I word. Like I literally watch people's eyes glaze over, because they just like whatever kind of like self-preservation somatic experience. Yeah. So yeah, I was very intent on trying to figure out how to and yeah, it means a lot that it's a book that people don't mind reading. Thank you.
No, that's very humble. Caleb, did you have a question?
Yeah, sure. So, hello. First of all, I'm a student here at the University of Connecticut in our insurance law program, and so I'm coming in with, I think, a little bit less knowledge than some of my peers in this call. But I found the article very interesting, and one thing you talked about in the article was kind of how during the post-war period there was also the creation of like multi-line insurance policies, but those were
Mm.
almost exclusively present in the suburbs, and they weren't offered inside of cities. And so my question really was, I think, a simpler one. It's why were those multi-line policies not available in the cities? And was that related to kind of the riots and the civil unrest that was happening, even though, these policies were kind of coming around in a period before that all had even started? And did that have any impact on how we ended up with these fair plans that ultimately were also not very helpful?
Thank you. Yeah, no, it's a great question, and one of those questions that I like. Um, yeah, I feel like I'm like a self-taught insurance scholar, so I like really had to figure out, yeah, even what multi-line policies were, and this is where we get to the specificity of insurance redlining as opposed to the mortgage variety, is that the homeowners policy, the multi-line policy, was this um, very it was a very suburban financial instrument, right? It was rolled out specifically for the suburban house, not just because of some like racial animus that insurance companies had, but rather because suburban houses, unlike the cities that these insurance companies had kind of grown up with and grown up around, right? Like that was the base of their business, was the urban landscape, an urban landscape that was extremely combustible and flammable. Suddenly they are kind of throwing their might and relocating their attention to a landscape that was much less prone to fire, right? Like these, I mean, this almost seems quaint in it today when we were watching these wildfires at the urban rural interface, like actually really spread through suburbs. But in the 1950s, suburbs were thought to be, precisely because fire can't is it's hard for it to jump from one ranch house to another. They were thought to be relatively low risk properties. And so the introduction of these multi-lines made it was a marketing opportunity in some ways for insurers to like charge more and be able to sign people up to insure against risks that like really didn't apply to them. But it really worked, and obviously the homeowners policy remains the norm today. What's fascinating is just how that financial innovation also meant the kind of formalization of redlining, right? As a kind of accidental byproduct, as opposed to in the mortgage field where it was very much a like it was a well articulated animus against these neighborhoods.
Thank you.
Great. Okay, so we're at the hour. I'm sure you'll all join me in thanking Bench for a tremendous paper, great presentation, super interesting. Go buy the book. And Bench, please come join us back again for future episodes of the Insurance Law Workshop. See the rest of you, or all of you, in 2 weeks.
Thank you so much.